IAS 2 is called Inventories. It is very similar to Ind AS 2. In fact, you can say both are same. If I remove the word similar also, then also it will not make any difference. So what is the objective of this standard? The objective of this standard is to prescribe the accounting treatment for inventories. As you have been knowing from your knowledge of your articleship, office work, that at the end of the year, we have to value our inventory. And after valuing the inventory, we will write it in the financial statement. This figure does not come from your books of account. This figure has to be valued and then incorporated in the financial statement. So therefore, a right or a wrong valuation will have a direct effect on your financial statement. Okay. So therefore, in this standard, we will be discussing line by line the various aspects relating to inventory valuation, how much inventory should be shown, how much inventory should be shown as asset or expensed during the year. So the focus of the standard would be on valuation of inventory, that is determination of cost and subsequent recognition as expense, including any write down to net realizable value. The standard also talks about write down in the value of inventory to net realizable value. This we will discuss in a later part, why inventories are written down below the net realizable value. And it also provides guidance on the cost formulas that are used to assign cost to the inventories. So this is like our agenda for the day now, what we are going to discuss. Cost formula, valuation tricks, then presentation in financial statement. First we'll go through three definitions. Definition of inventory as per Ind AS, as per IAS 2. Inventories are assets. Now tell me, what are assets? Assets. Why it is not written inventories are liabilities? Assets means these are resource controlled by entity. From which future economic benefit is generated. Okay. And arises out of past event. First three are important. These are assets because this will generate future economic benefit to the enterprise. You are going to use the inventory either for manufacturing finished goods and then sell. You will generate revenue, or you are going to, suppose it's a finished goods item, you are going to sell it and generate the revenue. So inventories are assets. Now what are these assets? This pen is also an asset. This computer is also an asset. Is it an inventory? Is this computer an inventory for us? No. Why? Because these are those assets which have either of these features: held for sale in the ordinary course of business. My computer is not held for sale in the ordinary course of business. It is not meant for sale in the normal course of business. You can't go to my office and say, I want to buy that computer. It is not for sale. It will be sold once its useful life is over, but is not meant for sale. But is the auditing book available for sale? Is an inventory. Ind AS book available for sale, inventory for us? Yes, because they are meant for sale in the ordinary course of business, like finished goods. Inventories are assets which are used in the process of production for such sale. They are themselves not sold, but they are used for producing finished goods which may be sold. So WIP, raw material, okay, or which are in the form of material or supplies to be consumed in the production process. So all those raw material and other similar items, components, they are consumed in the production process or used for rendering of services. So these are inventory item. Is a car inventory item? Depends. If it is held for sale in the normal course of business, yes. But if it is used for carrying managing director from office to home and home to office, then it is not a inventory. It will be a property, plant, equipment for that company. Some companies have got some cars, but what is the use of that car? It is used by the MD, managing director or CEO of the company for their commutation purpose. They are not inventory. So they will not follow IAS 2 for such cars. But if you are a dealer, a manufacturer, then you will follow this standard. Next is they have defined what is net realizable value. So one concept we will learn today called NRV. Net realizable value is the estimated selling price in the ordinary course of business. Again, you underline ordinary course of business. That means the price at which the goods are normally sold minus the estimated cost of completion minus the estimated cost necessary to make the sale. So do the reverse working. Take the selling price minus those costs which are required to complete the sale or make the, if the product is not in the finished good stage, some cost that might be required to complete it. Let us say you sell refrigerator for 10,000 rupees, but you give home delivery service to the customer. Transportation cost, loading, unloading cost is 500 rupees. So what is the NRV of this refrigerator for you? 9500. That means this is the net amount you will realize after completing the sale. So this is the money that will go to your pocket finally once this particular inventory item is sold. Okay. So tell me why we need to discuss NRV in this chapter. This standard says inventory will be measured at cost or NRV, whichever is lower. Why it says it will measure at cost or NRV, whichever is lower? Because the standard also says an asset should not be carried at an amount more than what you are expected to realize. Okay. So if this refrigerator we are talking about cost us 12,000 rupees, but on the reporting date we found that in case if I sell it now, after completing the sale, the net amount that will come to me is only 9,500. So therefore the standard says you can't show it at 12,000. You can't show it at 12,000 rupees. Is it right? Because this is not the amount you are expected to realize from the sale, and therefore you show it at only 9,500 rupees. What if NRV is more than 12,000? Say 15,000 is the NRV. Then 12,000 only. Inventories will be then valued at cost only. In this standard, you can't book the profit before you have actually sold the inventory, but you can book the loss if the NRV has gone down. What is fair value? This fair value has been defined in another standard called IFRS 13, fair value measurement. Wherever fair value word will be used in the entire IFRS, you have to refer IFRS 13 for fair value measurement. What is fair value? The price that would be received to sell an asset or paid to transfer a liability. So in case of asset, it is the price that would be received to sell an asset. And in case of liability, it is the price that would be paid to transfer a liability. When we sell the asset, we receive the amount. When we transfer the liability, we will have to pay the amount. Is it right? The amount paid to transfer a liability in an orderly transaction. Orderly transactions means normal transaction. Okay. Between market participants at the measurement date. Measurement date in our current chapter will be the reporting date. That is, if you are preparing the annual financial statement, it will be the last day of the year. If you are preparing quarterly statement or half yearly statement, then it will be the last date of that quarter or half year. One paragraph I have added from my side, not a part of the standard. What are the types of inventories? Normally in most of the businesses you will find following three types of inventories normally, and there are others also, like what I have noted in spare parts, small tools, okay, stores item, packaging items. First is finished goods. What are finished goods? Finished goods are items which are held for sale by a manufacturing entity and goods sold by a trading entity. If you are suppose a car manufacturer, Honda car company, so for them also that car is a finished goods. I am a dealer of Honda car. For me also it is an inventory. As long as it is held for sale in the ordinary course of business. And what is WIP? WIP are typically material that are issued for production out of stores and are in the production process, and other semi-finished goods in the process of production for such sale. So these are those items on which some work has been done. They are in the process of getting ready for being sold, but they are not yet ready for sold as it is. And what are raw materials in stores and other spares? These are the materials or supplies to be consumed in the production process or in the rendering of services. Now we'll come to scope paragraph. This standard is applicable to all inventories, okay, but it is not applicable to following inventory item like financial instrument. Even if financial instruments are held for trading purpose, we are not going to cover in this standard. It will be covered by IAS 32 or IFRS 9. Biological assets related to agricultural activity and agricultural produce at the point of harvest. For this you have to refer IAS 41 called agriculture. If suppose there is a mango on a tree, is this standard applicable? No. So this standard is not applicable for biological asset, means living animals and plants. If you have a cow, it may be your inventory. If you have chicken, it may be your inventory. But this standard is not applicable because we have a separate standard dealing with such items. Next is, this standard is also not applicable to the measurement of inventory. Underline. Previous 2 points A and B, 1A, 1B was not applicable at all. But for the following two items, 2A and 2B, standard is not applicable so far as measurement requirement is considered. Measurement word underline. Measurement will not be done as per this standard, but remaining requirement of the standard would apply. For example, disclosure requirement would apply. The standard does not apply to measurement of inventories held by producers of agricultural and forest products. Producer word underline. Producer, not the trader. If I am producing mangoes and selling in the market, then it is not applicable to me. But if I am trader of mangoes, is it applicable to me? Yes, because then I know my cost. A producer does not know what is his cost. The one who sells milk by milking his cows, he does not know what is the cost of that milk. But if you just buy the packed milk from one party and sell it to your customer, you know the cost. So the problem here is in case of agricultural and forest products, as far as producers are concerned, we can't calculate the cost. So therefore they have been given another option to measure the inventory. Producers of agricultural and forest products, agricultural produce after harvest, and mineral products. Why it is written after harvest? Up to harvest 41, IAS 41 will be applicable. So long as the fruit is on the tree, IAS 41 is applicable. Once the fruit is plucked from the tree, then this standard will be applicable for the other part, but the measurement will be done as per the standard specified here, to the extent they are measured at NRV in accordance with the well established practices in those industries. Valuation of such item is not very easy because you can't calculate the cost. So normally such people, they value their inventory at NRV as per the practice established in those industries. Okay. So measurement will be as per the respective practices followed by this industry, not as per the standard. This standard says cost or NRV, whichever is lower. But this kind of people, the producers, they can't calculate the cost, and they measure the NRV as per the practices formed in those industry. When such inventories are measured at NRV, the change in the value will be recognized in profit and loss account in the year of change. So we will also discuss this again in IAS 41. This paragraph has a linkage to IAS 41 also, agriculture. And now next is, this standard does not apply to measurement requirement of inventory held by commodity brokers. Who are commodity broker traders? Commodity broker traders are those who buy or sell commodities for others or on their own account. So either they buy on behalf of others or they buy on their own account. And these people who measure their inventories at fair value less cost to sell. So not applicable to commodity broker who measure their inventory at fair value less cost to sell. They are allowed to follow this method as far as measurement is concerned. Which method? Fair value less cost to sell. When such inventories are measured at fair value less cost to sell, change in fair value less cost to sell will be recognized in profit or loss in the period of change. I have written some more information about point number B. Inventories referred to in paragraph 2B are principally acquired with the purpose of selling in the near future. Normally what these commodity brokers or traders do, they are interested in making quick profits. They know that the price of sugar is going to rise, price of wheat is going to rise, pulse is going to rise. Okay, so they may store it for some time and then they will make huge profit if their expectations go rise. So these are principally acquired for selling in the near future and generating a profit from fluctuation in the price or broker traders margin. When these inventories are measured at fair value less cost to sell, the standard says they are excluded from only the measurement requirement of the standard. Measurement will be done as per fair value less cost to sell. So for producers of agricultural and forest produce, what is the exception? They can follow NRV method as per the practice in those industry. For the commodity broker and traders, they can follow fair value less cost to sell. But other requirements of the standard would apply, like disclosure requirement would apply. Is it right? they are not totally exempt from the application of IAS 2. Now, the golden rule of this chapter will be this line: inventory will be measured at lower of cost and net realizable value. We discussed the reason for that. If NRV goes down, then the basic principle of standards are usually assets should not be shown at a price above their realizable value. Okay, otherwise your statement of financial position is misleading. If an inventory whose value is 9,500, you can't show it at 12,000 rupees. So better you show it at 9,500 rupees only. But if the NRV goes up, you show it at cost. Do not recognize the profit before it is actually sold, because it is meant for sale in the ordinary course of business. Now, one small question we will take on this. An enterprise has in its stock 10,000 bags of cement purchased at a cost of rupees 180 per bag. The terms of the trade are that this cement is delivered at the buyer's door and the cost of delivery is rupees 10 per bag is to be paid by the seller. Selling price of the cement is rupees 187 per bag. Find out the value of the closing inventory. So how do you find out the value of the closing inventory in this case? First, I need to find out what is the cost. Cost is 180. Then I need to find out what is the NRV. So what is the selling price in the normal course of business? 187. What is the cost of delivery? 10 rupees. So what amount will finally come to your pocket? 177. So we will use 177 for valuation. How many units of cement bags are in your stock? 10,000. Multiplied by lower of the two. So it will be 17 lakh 70,000. Okay. So now next few minutes will be spent on understanding what is cost. That will take more time. And then next few minutes we'll understand what is NRV. What will be included in the cost of inventory? So inventory cost will comprise of all purchase cost, cost of conversion, and other costs which are incurred in bringing the inventories to their present location and condition. So then the question will be, what will be included in purchase cost? Is it right? When we buy inventory, what are the costs associated at the time of purchase? Basic purchase price, any duty or taxes like import duty, then in goods and service tax, transportation cost, handling cost, any other cost directly attributable to procurement of goods, material and service. Okay. Any other cost means, for example, you may take the help of a consultant as to which item you need to buy. That you can add. Some of your employee may travel to do the inspection of the inventory and select the inventory. That also we can add. Okay. Because these are the costs directly attributable. And after adding all these items, taxes will not include those taxes that are subsequently recoverable from the taxing authorities. Example, input credit. Okay. In some countries, if you pay tax on input, you can set it off against the tax payable on finished goods. So in that case, input credit will not be shown as a part of inventory cost. It will be shown as a separate asset. It will appear as a separate asset. It is like an advance that you have paid, which you can set off against your future tax liability. But if input credit is not available on that item, then you will add it in the cost of the inventory. What about trade discount and rebate? When we buy in bulk, we get trade discount and rebate. Trade discount and rebate will not be shown as an income. Rather, the cost of the inventory will be reduced to that extent. Is it right? What is conversion cost? Conversion cost means the cost that you will incur to convert raw material into finished goods. This is conversion cost. Okay. So conversion cost would basically be direct labor, direct expense, and plus production overheads. This standard only allows you to add production overheads. Administrative overheads are usually not allowed to be added unless they are specifically incurred to bring the inventory to their present location and condition. Okay. The allocation of the overhead is like this. So I have made a small summary of how are you going to allocate the overheads. Overheads are of two types: fixed overhead, variable overhead. As you know, fixed overheads are those indirect costs that remain relatively constant regardless of production. And variable overheads are those that vary directly or nearly directly with the production. Very directly or nearly directly with the production. So what the standard says about the allocation of variable overhead, it should be based on actual rate per unit. Variable overhead will be based on actual rate per unit, and fixed overhead will be based on normal capacity. Okay, fixed overhead will be based on normal capacity as long as your production is equal to or less than normal capacity. But if your production is more than the normal capacity, then you are going to use actual capacity. Okay. In the next paragraph, we have written the meaning of normal capacity. Paragraph 10 on the next page, probably you'll find. First, we will see what is normal capacity, because our discussion now revolves around this term called normal capacity. Is it full capacity? Is it maximum capacity? No. Then what is normal capacity? Normal capacity is the production expected to be achieved on an average over a number of period or seasons under normal circumstances, taking into account loss of capacity resulting from planned maintenance. Many people find it difficult to understand what is normal capacity. Now this is your factory. This is 100% capacity. If your company is in existence for a long time, many years, then what you have to see on an average, what is our capacity utilization? Okay. So from your past data, you can find out that we are able to utilize 80% of the capacity in the long run. So it is the capacity utilized in the long run. While calculating this normal capacity, you have to take into account that you will not be able to utilize the full capacity. Some loss is going to be there. Throughout the year you can't produce. Sometimes we have to undergo some kind of maintenance program. Sometimes the nature of the business is such that every day or every month you can't produce the same thing, same quantity. Okay. So what we need to see in the long run, what is the percentage of capacity that is utilized? What if it is a new entity? Then there is no history of past performance. Then maybe you can see the industry trend. Practically how you are going to apply if it is a new company. Then in this industry, on an average, what is the capacity utilization? So some degree of judgment may be employed here in calculating the normal capacity. Okay. After understanding normal capacity, now we'll see the allocation of fixed overhead. I have divided into three parts. For solving a question in the examination situation, the three possible situations for fixed overhead could be actual production and normal capacity are same. Theoretical possibility for intellectual discussion. Actual and normal both are same. Then it actually doesn't matter. You can apply normal capacity or you can apply actual capacity. So there is one small example we are going to solve, which is printed as problem number 2. Case 1. Can you see case 1? So you will take a pencil and do the fill in the blank in case 1. Right there. Case 1 you write down actual is equal to normal capacity. Start writing first column only. Normal capacity, write 2 lakh units. Fixed overhead 8 lakh rupees. Actual production 2 lakh units. Allocation of fixed overhead per unit. So which number I will take? Any number. 8 lakh divided by 2 lakh, 4 rupees. So what will happen? How much will be your fixed overhead allocated over the sales? Actual sale is 1,60,000 unit and actual inventory is 40,000. So the amount that will be included in the cost of sale would be 6,40,000. Sir, how did you get this number? 1,60,000 into 4. And what will be the fixed overhead that will be included in the inventory? 40,000 units are lying in your closing inventory. 4 is the fixed overhead per unit. So you will write 1,60,000. So in this case, your entire fixed overheads gets absorbed. Either over the cost of sale or over the cost of inventory. So amount charged as period cost under absorption nil. Right, nil. Case 2. You have to understand case 2 and case 3 and the logic of that. The case 2 says that actual production is less than normal capacity. Then in that case, you have to allocate the fixed overhead on the basis of normal capacity, not on the basis of actual capacity. Otherwise, your inventory will be overvalued. Your production is less than normal capacity means there is some degree of inefficiency. If you use actual capacity for allocation, your inefficiency will get added to the inventory cost and it will get transferred to the next period. The standard says no, you can't do that. So this unallocated fixed overhead will be treated as an expense in the period in which they are incurred. So once again understand, suppose my fixed overhead is 10 lakh rupees and my actual production is 1 lakh units, but my normal capacity is 2 lakh units. My normal capacity is 2 lakh units and my closing stock is suppose 50,000 units. So this question they ask in the exam also, how much fixed overhead will be allocated here? If I take 10 lakh and I divide by 1 lakh, my allocation will be 10 rupees. If I take 10 lakh and I divide by normal, my allocation will be 5 rupees. Which one I will use? 5. If you use 10, your inventory valuation will be on a higher side. You're utilizing only half of your normal capacity. it means you are inefficient. Inefficiency cannot be loaded over inventory cost. Is it right? So you have to bear that inefficiency by charging to profit and loss account. So let us write the example 2, case 2. Write down normal capacity in case 2 column 2 lakh units. Fixed overhead 8 lakh rupees. Actual production 1,60,000 units. Actual production 1,60,000 units. Allocation per unit rupees 4. Why 4? Why not 5? I will take 8 lakh divided by 2 lakh. Not 8 lakh divided by 1,60,000. So this 4 rupees is equal to 8 lakh by normal capacity. Now actual sale is 1,50,000 unit. Dear student, answer. What is my actual inventory? Actual inventory will be 10,000 now. Out of 160, 150 sold. Value this cost of sale. How much fixed overhead will be included in cost of sale? 1,50,000 into 4, 6 lakh. How much fixed overhead will be included in the cost of inventory? 10,000 into 4, 40,000. You will find your fixed overhead incurred is 8 lakh, but absorbed so far is 6 lakh plus 40,000. So what about the remaining? The remaining will automatically get charged as period cost. 1,60,000 under absorption. There is no provision of carry forward of under absorbed overhead to the next period. Is it right? And what is the third possibility? The third possibility is your actual production is more than normal capacity. Actual production is more than normal capacity. Good news. So which figure I will take now? Actual capacity. Okay. Say the same example. My fixed overhead is 10 lakh. Actual is 4 lakh. And normal is 2 lakh. For whatever reason, let us say. So now my overhead allocation will be based on actual 4 lakh 2.5. If I use normal, then it will become 5. Two reasons understand. One, if you use 5, your inventory will be valued more than what you have actually incurred. But one more problem will arise here. You will over absorb the overheads. You will absorb the overhead more than what you have incurred. Is it right? Let us assume for the time being 10 seconds that your entire 4 lakh units are in your closing stock. For the timing, assume you have not sold the inventory. So if I apply 5 rupees for valuation purpose, the overhead absorbed will become 20 lakh, but the actual overhead incurred is only 10 lakh. You can't over absorb the overheads. In accountancy, we will only record what we have incurred, not a hypothetical number. Okay. So therefore, we will take actual so that there is no possibility of over absorption. Inventories are not valued at a higher than what cost you have actually incurred. Dear students, solve this third case. Case 3, write actual is greater than normal. Normal capacity 2 lakh. Fixed overhead 8 lakh. Actual production 2,50,000 units. This time I have kept this answer for you. What will be allocation per unit? Is it 8 by 2 or 8 by 2.5? So the answer will be 8 by 2.5, 3.2. I will give you one figure, remaining you complete. Actual sale is 2,25,000 unit. complete till the end. What will be actual inventory? 25,000. What will be the amount included in cost of sale? 225 into 3.2, 7,20,000. What will be the amount included in cost of inventory? 80,000. So therefore amount charged as period cost will be nil, because the total of the overhead absorbed, these two total 8 lakh, is equal to the fixed overhead actually incurred. If you would have taken 2 lakh, this will become 4 rupees, and the total of these two will exceed 8 lakh rupees that you have incurred. So what is the rule you will follow for fixed overhead? Actual or normal, whichever is higher. Actual or normal, whichever is higher. Or you can say, if the actual is equal to or less than normal, use normal. If the actual is more than normal, then use actual. Okay. Question number 3, homework. Same problem. So try as homework. Now come to paragraph 11. Treatment for joint product. What is joint product? So sometimes the nature of the production process is such that there is one input, but it results into two or more outputs. Is it right? Now the problem will arise how to allocate this joint cost. The cost is incurred is joint. We don't know actually how much goes for A or B or C, right? So therefore the standard says, in case if the nature of the production is such that the cost incurred is common and you have multiple output, then you have to allocate it on a rational and consistent basis. That means you have been given a lot of liberty here. Rational and consistent basis. So you have to design a policy and follow it consistently, which should be rational. What is the suggestion they have given? For example, this is their recommendation. Such allocation may be based on relative sales value at the separately identifiable stage or at the completion. That means there are two choices they have given here. You can take the relative sale value at the point where they separated, or you can take the relative sale value after they are completed into finished product, if some further processing is also required. Students of costing will remember there was a chapter like this. So you have to apply that chapter and get the answer. So one easy question first I will solve. Is this question there in your book? Or it is there in the cell practice part? Just check. Or what I'll do, I will not solve this one. I will solve the one which is printed in your notes. That is easier. It is that you write homework. Problem 22 homework. We will solve this question. It has less number of units. Okay. Question number 4 in your book says 5,000 units of X and 2,500 units of Y arise jointly from a production process involving a total cost of 2,60,000. So from one single process, two types of products emerge, Y and X. If the sale value at the split off point is 100 and 60 respectively for the product X and Y, explain how the joint cost of conversion will be allocated to the products. So what you will do, you'll first find out the relative sales value X, Y. What is the output you have produced? 5,000, and in the exam write in detail like this is printed in your notes. What is the selling price per unit? 160. 160. So what is the sales value? 5 lakh, right? And 1,50,000. Just check, is it right? So the logic of this method is that the one which have a higher sale value should bear more expense. Is it right? And then we will allocate the joint cost of rupees 2,60,000. Is it 2,60,000? In the ratio, what is this ratio? 500 is to 150. So that means I can say 10 is to 3. So try 10 by 13 into 2,60,000. 2,60,000, sorry, into 10 by 3 is how much? Is it 2 lakh? Is it 2 lakh? And what about the next one? 60,000. So this is the allocation. And if they ask you per unit cost, so the cost per unit will be 2,60,000 upon 5,000. So 40 rupees. Sorry, 2 lakh. Is it 40? 60,000 divided by 2500. How much? 24. Mostly in the exam they also give you one more information. They will say suppose 1000 unit of X and 500 units of Y are in your closing inventory. Find the value of closing inventory. So if you have 1000 unit of X and 500 units of Y, you will multiply them, get the total, and that will be the value of your closing inventory. Okay. Now we'll continue on Monday.